So, what are some of the simplest ways to invest? Well, the simplest is, of course, to open a savings account in your local bank with your local bank. Walk in, open an account, sign some papers, and you're ready to good to go. And you can have your first savings account without much problem. And you may deposit your, checks and all that you've received or cash that you received from your relatives over, over your birthday or any of those, occasions during holidays and holiday season and stuff like that. So that's the simplest way. Unfortunately, as I said, savings accounts, even in the best of times, will only give you relatively small rate of interest, even in the best of times. And therefore, your growth will be seriously hampered. If you're looking for using your savings account as a way to grow your wealth, that's probably not the best way to go about it. The other way is a common way is to get open up a brokerage account, which these days you can do online, some paperwork again, and you can set yourself up for $50 or $100 as little as that, and you can start dipping your foot or feet into the stock market. So when you think about buying stocks, the question to ask is, why do companies sell shares? Why do companies sell shares? Well, the companies, just like us as individuals, and I always like to use the analogy between what companies do and what we do as individuals, we all like to improve our lives or improve ourselves. Companies like to grow. And in order to grow, companies need money. And there are different ways a company can raise money. One of them is to sell shares of themselves. And the other way, which we'll talk about later, is to borrow money from the capital markets by selling bonds. And we'll talk about bonds later in the course. But selling either stocks or bonds are the two most common ways companies raise funds. They can also, you might say, how about borrowing money from banks? Yeah, that would be true, except that banks don't have the deep pockets to lend out the kind of money that companies need. Banks don't have those, for the most part, they don't have those kind of resources to lend money on that scale. It works for us. Think about it. When we want money, unfortunately, for most of us, we can't sell shares on ourselves because we have no market value in that sense. Although creative people who are musicians and others who have a source of income through their activities can sell shares and have sold shares of themselves. But that's a discussion for another day. But for individuals, the most common way for us to get money to buy things we want, like a house or car, is to get a bank loan. For companies, the problem is that their requirements are so large financially that banks will not be able to handle that kind of. Most banks will not be able to handle that kind of demand, and therefore companies prefer to go to the capital markets to either sell shares or to borrow money by selling bonds. So when you buy shares of a company, what's the good and bad of it? The benefits and costs of investing in shares. The good is that if you've done your research and you've got a little bit of luck going your way, that markets cooperate with you, then if you invest money, you will see the value of your shares increasing over time, and also some of these stocks will pay a dividend, which is a company's way of paying back some of their profits every quarter. And so you can earn, and in your portfolio can grow as a result. The downside, well, another benefit of stock ownership is that you get a say in the company's affairs, if you will. Every company that's publicly traded, that has shares trading on it in exchanges, will have annual shareholders meetings where, if you choose to, you can either attend in person or you can mail in your vote. Most of us choose not to. We ignore it because we don't own enough shares. I mean, if you have 200 shares, or 100 shares or 50 shares, it's what we call, you're an atomistic shareholder, right? You own a very, very small percentage of shares, to feel like you make a difference. That is not to say that you shouldn't do it. A lot of people I know have 100 shares or 200 shares and still dutifully fill out their ballots every year and vote and so on. But this right to vote is very fundamental. It's like, as a US citizen or a citizen of any country that you live in, you have the right to vote. You have, one vote for your election to elect your whoever it is for a elected office, and you have a right to vote. It's the same thing with corporations, that you have, it's one share, one vote for the most part, and therefore if you have a share, you get a vote. If you have 100 shares, you have 100 votes. There are some companies that are slightly different in that, but for the most part, this is true. And so you get the right to vote, you earn money, and then of course the bad thing is that you can also lose money. Remember, these are risky investments. There's risk involved. That simply means that while you can make money some of the times, you can also lose money some of the times, and that's the not so good aspect of investing or any risky activity. Not just investing, anything that has risk. Driving has risk, right? When you're out on the street in your car, you can, have an unfortunate accident that can, set you back in multiple ways. So there's risk involved, and understanding that and being able to deal with it is real key. Now, I want to be clear that for the most part in this course, we'll be talking about what is called common stocks. There's another category of stocks that I will not address here in this course, known as preferred stocks. Preferred stocks are sort of a hybrid of common stocks, as they're known, and bonds. They have properties of both. And it's not something that individuals invest in for a number of reasons. Corporations, however, have a lot of companies have preferred stocks, which are bought by other corporations, other companies buying different companies' preferred shares. And that's a slightly advanced topic that I will leave aside. For the most part, and what we deal with around us, 95 to 99% of the times is common stock. So whenever you hear people talking about stock investment, you can be sure more or less that they're talking about common stocks. And so when I say stocks from now on, I will be meaning that it's common stock, okay?